Liechtenstein and Hanks, another big intraday move in the gold yesterday, sharply lower, down 1.75% into the equity cash close. For a closer look at the metals, I'd like to welcome Alan Nuckman, Chief Market Strategist at Agora Financial. Alan, thanks for joining us. Thanks for taking the time to be with us on the show today. I want to get right into it. The move that we saw in the gold yesterday from 1333 to 1327 roughly. Why the wide range intraday moves, but no real follow through one way or the other on the bigger picture in the gold?
Well, I've said this a couple hundred times before, and I'm going to say it again. All about the dollar. It's the dollar. So last week we had the dollar take out that extreme low, but did so kind of begrudgingly, and it's firmed up since that time. So we didn't get any follow through on the downside of the dollar. What was interesting in gold last week is gold added $40 or more on a weekly basis when we saw asset reflation. We'll talk about that in a second. But you did not see new relative highs in gold. Gold got up to $13.65, so it was $5 short of that $13.70 level. So you're seeing a little divergence there here in the short term. But for anyone to say that the dollar is done going down, I think it's premature. Let's see how it reacts again. We've had a little firmness over the past couple days. We did have that euro currency bounce up to the 125 level, or very close to it, up to the 124, which is kind of the halfway point of this recent break. The euro currency added 300 points last week, so it needed a little bit of a pullback yesterday. Let's see where we are by week's end in the currencies.
Alan, you're exactly right. Ben and I were talking during the break how the 5-day chart, if you put up like a 5-day, 5-minute chart in the dollar, it hit, in terms of the dollar futures now, it hit 88.15 and has gone straight up since then, and that has had its effect on gold, right? I mean, gold has been, if you look at the chart, you can't deny the relationship between the dollar and gold.
Yeah, we try and make it simple, and it is that simple, to be honest with you. But you said the dollar went straight up, but let's talk about what straight up means. Straight up means a point and a half. We're not going straight up 4 or 5 points. You're getting a little bit of firmness, and I think what we had was just some short covering when it didn't blast through that base and go a lot lower. So, let's see how the dollar reacts, but that's obviously what's driving these metals markets right now. But to get back to asset reflation, another factor that you want to keep an eye on in the metals market is that you saw last week, you saw the asset markets up $2.50, which is a 5% move. You saw gold up $40, and obviously the stock market was up 4% in the Dow and the S&P and up 5% in the NDX. So we had that profit-taking plunge, and it was across all asset classes. And again, I'm going to keep saying profit asset classes, but then we had a recovery last week. I'm not worried about inflation. This is simply, reflation of assets. If you look at long-term rates, we were at 4% in the 10-year just back in 2013. So we're approaching 3%. That doesn't scare me. We've moved up maybe 1/4%, near less than 0.5% in the last few months. So, yes, rates have to go up, but if you look at the futures markets, it's going to happen in March, and, there's over a 50% chance it happens in June, but then you get out to September, it's below 50% again. So, it's not a march of rates that everybody's so worried about. I think it's going to be gradual, and the Fed's going to continue to do their job.
Alan, I want to tie that rates discussion back on over to the copper, because prices have been on the rise after it traded multi-year lows, briefly back down below that $2 level in the beginning of 2016. But I'm wondering, how much demand can we expect for copper in the coming months if rates are on the rise?
I was listening to your last guest talk about housing and interest rates being higher and so forth. And, if someone hasn't locked in a house, given this opportunity in the last 4 or 5 years, they weren't ready to buy a house. So that's not going to buy a house. They buy payments, as someone had famously said, and so the payments are going to go up another $50, $100. I mean, that's not of the economy, because housing was such a large component back in the 2008 and so forth, below around that time. But I don't think it's that much of a measure anymore. I think it's a healthier sign of global growth, because $3 is very encouraging, and like a lot of commodities have not participated in this latest asset super cycle, and I think they're going to be the last part. It can be the catalyst. Look at copper. Look at somebody like Freeport-McMoRan, which has come storming back, in approaching that $20 level one more time. I think there are a lot of value stocks. People are always looking for opportunities in stocks. Energy's had a pullback. Metal companies, mining companies. I think that was part of the catalyst on this latest market rise in the equities markets. I think that could be the next leg up in stocks when these commodities markets start to march forward one more time.
Alan, you talked about the commodities that haven't participated in this move to the upside. Silver is definitely one of them. We've been watching it shop around 17. What's it going to take to get silver out of this 15 to 19 range? It's been stuck in this for over a year.
You ask me these difficult questions. I don't know what it's going to be, but I'll know it when bit of a run. But looking at the big picture, you can see that it's been range bound for the past couple of years, just like the gold market has been. So at some point there'll be some movement there, and then we'll just have to take advantage of it. But I think from a reward to risk standpoint, I don't think there's a whole lot more downside in the metals if you can look long term. If you can look at some options that have 6 months, a year of time. That's how I like to position, because I'm not going to be the guy that's going to be able to time that breakout, but I'm going to have enough time in an option so that I'll be there when it does happen, and I'll be there. I'll have enough time to be right, as I like to say.
Alan, another soft number here in mortgage applications. Now, we all know this is a pretty volatile number, but with the 30-year mortgage rate now at 4.64, that's the highest since 2014. What are you seeing in terms of what interest rates are doing? I mean, obviously we know mortgage apps are a volatile number, right? It's a weekly number. It come out really volatile. But, now this is 2 weeks in a row now of pretty significant softness in mortgage apps.
Right. You've got to take a 4-week moving average on any of those kind of numbers that have that kind of those kind of swings. So we know that game. But I'm going to ask you the question. So where were rates in 2013 and 2014 when we had the 10-year at 4%? You said we haven't been up to that in a couple weeks. How did the stock market react from 2013, 2014, 2015, 2016, 2017? How did the stock market react afterwards when those rates were that high?
Right.
It went straight up. It went straight up. So why would it be different this time?
Exactly right.
So rates were high at that time, but the market yeah. So I'm not looking for anything to change, and I don't think anything's different this time with this market pullback. Yes, it made people uncomfortable, but it needed to be done. And I'm going to say it again, profit-taking pullback. And a great example yesterday is Walmart. You talked for 15 minutes on Walmart missing their numbers. Actually, they had better revenue numbers than expected. They missed on EPS a bit. But the disappointment was either or. It's not an either or. Walmart made $2 billion in profit for the quarter. They didn't suffer. They didn't suffer at all. But the stock had gone up 40% in the last 6 or 7 months. So of course there was some profit taking. That's how you have to look at it. It's how things recover afterwards. Where do we go from here in the next few weeks, next few months, as far as Walmart goes? But to be disappointed in making $2 billion for the quarter and beating your revenue numbers is ridiculous. Now, looking at the S&P stocks, 80% of the stocks have reported so far, and 75% have beat EPS, and 78% have beat revenue. That's the highest number since they've been recording since 2008. So there's the stock market is not suffering by any means, and the PE ratios dropped to 17, and the 5-year average is 16. I don't think we're overvalued.
Yeah, and with some of these good earnings that we're seeing coming out, for the most part, you would think stocks would be lower in this recent sell-off if we didn't have that kind of supporting price activity. But I'm curious today, Alan, what are you going to be looking for today with the FOMC minutes at 1 p.m. Central Time?
Oh, geez, I don't know how to dissect it any more than we have been doing for the past 6 or 8 years. I just have to have confidence that the Fed's on the right path, as they have been. They've gotten us where we wanted to. They've nudged us and told us what we wanted to hear sometimes and what we didn't want to hear sometimes to get the proper reaction. So they played us perfectly. They've herded us in the right direction when the markets were getting a little bit overheated or a little bit we had the deflationary concerns. So I've got confidence that the Fed's going to continue to do what they're doing. Like we said, looking at the Fed fund futures, there's that rate hike in March, and then we'll start looking at June. But Unless, and this is the only unless someone brought up the other day, unless we start talking about, a half a point hike instead of the quarter point hikes, I don't see this having any impact on the markets at all. It's a slow, gradual thing. It's still going to take 3 years to get us back to normalized rates. And boom, we're back to normal rates.
Yeah, and the transparency on the Fed's behalf seems to have buffered some of the impact that you would expect to see in a higher rate environment. But traders, that's Alan Nuckman. He's the chief market strategist at Agora Financial. Alan, thanks for coming on today. Really appreciate your insight. A big mover